Hello and welcome to another episode of Darwin Investors. In the last video, I showed us how we could build a portfolio using investment grade stocks and talked briefly about how to trade options off of those stocks. In this video, I'm going to talk about how to optimize your portfolio using those stocks so that when times aren't so good, you can continue making money while we wait for the market to pull out of this funk. And after this video, I guess I have to go clean my garage. So uh, we're going to see. I guess it's going to be a pretty long video. So let's go ahead and share my screen and we'll get right into it. All right, so this video, the point of this video is we're going to try to understand trading, and it's going to be like kind of like a bird's eye view of trading, and just kind of like we're going to skim the surface. I'm not going to go deep into every little thing, but what I'd like to do is just kind of give you just kind of like like an elementary level version of what trading is and how to keep your portfolio afloat through what I think is about to be still some tough times. I know we had a great week, but I don't believe we're out of the woods yet. I think that it's not going to be smooth sailing. Let's put it that way. And there's going to be no easy money on the table. And it's not going to be like, let's just go buy whatever we want and it's going to go up. It's not going to be like that. At least I don't think it's going to be like that. Could be wrong, but I just don't think it's going to be like that. So what we're going to have to do, we're going to have to be vultures. We're going to have to go in. We're going to have to scoop up, like look for something, look for a deal, look for a trade, maybe trade out options on our really solid stocks that we've already researched and put into our portfolio that we have no intention of selling because we know that they're good. But we're going to go ahead and we're going to vulture out and try and keep our profits coming in even in a down market. So we're going to talk about options and how to do that. So, and then at the very end, I'll give you an example it's a very comprehensive example of a position I'm in right now that should cover all of the bases. So go ahead and stick with me till the end, and hopefully that's longer versus shorter because I'm in no hurry to go clean the garage. So okay, so puts and calls. You know how like with computer programming, I was a computer programmer once upon a time, and everything that you see on the screen here is zeros and ones. It's true or false. It's Boolean. It's basically these two concepts, true and false, open up this entire universe, and some might even say a metaverse of possibilities. But it's all based on these two simple concepts of true or false. Well, that's the same thing that you have with options and stocks. So if you're mathematical in nature, you probably do really well at trading options. But we're talking about true and false. We're talking about puts and calls. Now, just because you've bought a put, just because you're trading puts doesn't necessarily mean you're bearish. Bearish means you think the market's going down. And just because you're dealing in calls doesn't mean you're necessarily bullish, meaning you think it's going up. I think a lot of us think that if you buy a call that you think the market's going to go up, and that is true. But if you sell a call, you're kind of hoping it goes up to a point, but then it doesn't go up too high, and so you're kind of bearish on the market. Same thing with puts. If you buy a put, you think the market's going down. And if you sell a put, you want it to stay above a certain strike price. So it's a very bullish move. You're basically betting that whatever underlying is not going to go below the strike price that you've set forth. So when you're dealing with contracts, you're dealing with 100 shares of the underlying. It's why people find it addicting or what have you. You're not dealing with one share anymore. Every time you buy a contract and it moves, you're dealing with 100 shares. So you have the ability to control 100 shares of the underlying stock for just fractions or pennies on the dollar for what you would have to pay to buy the 100 shares. But it comes at a price, meaning that things don't move up and down quite as they would as if you own the shares outright. Meaning when something goes up a dollar, you're up a dollar, down a dollar, you're down a dollar. And we'll go into that a little bit more here coming up in a second. So like I said, one contract is equal to 100 shares of the underlying. One call contract, so you bought a call contract, and you say that the contract costs you $500. Remember, there's 100 shares, so it's $5 per share. And so you bought the contract for $500, $5 per share, with a strike price of $100, means the break even is $105. Meaning that in order for you to start making any money on this call that you bought, the underlying share price would have to go over $105. So each one of these trades has, and this is very important, an intrinsic and an extrinsic value. So let me go ahead and show you what I mean by this. So the intrinsic value is the value of the share itself. When it goes from 100 to 105, the intrinsic value of that is $5 per share, or $500, right? And the extrinsic value is the time to maturity. So time is worth money, and also volatility is worth money. So what I'm saying is that if you bought a call and it was $100 with a $100 strike, it would have you'd have to pay a different premium depending on the time to maturation. Things that go further out in time cost more because they're more volatile. So you have intrinsic value and you have extrinsic value. And so the intrinsic value is essentially the difference. It's what it is. So if something is $100, that you bought it for $100, and you paid $5 for it, so now your break even is $5, and it ends up at $110. Your intrinsic value would be the difference between your break-even price and the price it is now. So if it goes from 100 to 110, your break-even is 105. Your intrinsic value for that contract would be $5 a share, or $500 at expiration. However, if before expiration, let's say it's 2 months before, it's not going to be worth $5 or $5 per share. It's going to be worth considerably more, especially several months going into expiration. And why is that? Because someone is paying you for the time, and they're paying you for the volatility, which is associated with the time. And I hope that this doesn't confuse too many people, but listen, that this is very very important. And I got these two mixed up. This should be extrinsic, this should be intrinsic. So the intrinsic value is the share price, and the extrinsic value is the time and the volatility. So let's go ahead and look at the Greeks here. So there's a lot of different Greek symbols that they use from options, but by and large, we only worry about 4 of them. Oh, it even says here, the 4 factors for measuring risks. There are more than just the 4, but these are the 4 we're particularly interested with. Delta is the measure of change that the options price changes for the underlying asset every time it moves $1. When the option, let's say it's $100, let's say that you buy something for $100 and it moves $1. The delta is going to be 50, meaning it has a 50% chance to go up $1, and it has a 50% chance to move down $1. So the delta, not only, it's basically a percent that you have to win. So when you're selling call options or when you're selling puts, you want the delta to be very large, because you're saying that I would prefer to have an 80% chance to win than a 30% chance to win. When you have the delta and you're buying calls, the delta is positive. But let's say it's positive 80, it means that you have a 80% chance to win or break even. When the delta is negative, it only means that you're working with puts. You're working in a negative direction, but doesn't mean anything different. If the delta is negative 80, it's still an 80% chance to win, but in the negative direction. You've either bought a put or sold a covered call. So that would be delta. Gamma measures the price that it would be the next dollar it moves. So what delta is the first dollar, gamma is the second dollar. So if the delta is 50 and the gamma is 15, that means that for every dollar this moves, the first dollar is $50, the second one is $65. And it comes to a point where when you have options, and this is what's so intriguing, because now you've used a little bit of money to buy a call, you start going far out in time, right? You start going far out in the money, and gamma gets closer and closer to 0, and delta gets closer and closer to 1. So that dealing with these options, even though you didn't pay that much money for it, works exactly like buying the stock itself, which is the ultimate delta play. Buying the stock is actually the most risky thing you can do. Next thing you have to talk about is theta. Theta is not actually addressed here, it doesn't seem. I don't know why. But theta is the time decay of the stock. Let me go ahead and see if I can drum this up. No, doesn't seem to be. Theta is the time or the rate of decline of the stock to maturation. So as you're further out in time, let's say your option's worth $1. And if you're further out in time, the theta doesn't decay very quickly. It's still worth $1 6 months out, according to theta. But the closer it gets to time to maturation, theta drops off a cliff. And theta becomes worth more and more and more until finally theta is 0, meaning like it's worn off all of the, it starts off at 0 and ends at 0. Like basically, it starts off at 0, meaning it's not taking anything off of your share price every dollar it moves, until finally at time to maturation, it's maximized everything it can do. There is no more time. There is no more theta, right? So the closer you get to time to maturation, the more theta you've burned off. And last but not least, there's vega. And vega would be the most important measure. If I had to put one that say it's the most important, it would have to be vega. Vega is the volatility. So theta is important because that means that when you sell something, and I'm going to just ask you a quick quiz question here. When you sell something, do you want a lot of time? Like if you're going to sell something and you know that every day it burns more of your theta, do you want to sell it like further out in further out in time or closer in time? You're going to want to sell it closer in time, because the second you sell it, you want it to start burning theta like crazy until it finally goes to 0. And all you're left with is intrinsic value. And then vega, what that does, this is your implied volatility. And remember, extrinsic value was implied volatility in time. Not all stocks have the same kind of volatility. My JP Morgan, I can't possibly sell, it seems, a covered call on this stock. There's not enough volatility to give me a premium that I think would be worth it to sell a covered call on that stock. But the volatility drives up the premium on the stock. So highly volatile stocks command a big premium. So if you sell a covered call or sell a put, on a highly volatile stock, you're going to get more money. If you buy, now here's the other thing, if you buy a call or buy a put on a highly volatile stock, you're going to pay more premium. It's going to cost you a lot of money, right? So my rule of thumb is that when Vega is high or implied volatility is high, you probably shouldn't be buying calls and puts. You should probably be a seller of options. When it's low, you should probably be a buyer of options. And that's my rule. Okay, so those are the Greeks that I was going to talk about real quick. So how do we use the volatility? Well, I think I just talked about it, that we would essentially sell when volatility is high, buy when volatility is low. Volatility is measured on this thing called the volatility index. Here's the VIX. Now this is, of course, a volatility of all the stocks combined in the entire stock market. And right now it's sitting at 23. 30 would be considered very, very, very high. And 12 would be considered, kind of low. But just like the S&P 500, all stocks don't trade with the same volatility across. Some might have a volatility of 100, while others are sitting with a volatility of 10. So this is not a broad stroke, but you can say that if it is high, more stocks have high volatility than not. That means the market's generally crashing, and so there's going to be some high volatility. Let's expect some high volatility going forward here in the future. So let's go ahead and talk about a trade that I'm in right now. So let's go ahead and look at my current call options that I have. Looks like I have no sold puts at the moment. They're all covered calls. Now we had a big week last week, which means I would be down on a lot of my positions. Let's start with AMD here, just so we get an overview of this. AMD, I sold a covered call that says if it finishes below $125 by March 25th, I would collect $36. Doesn't seem like a lot of money. I tend to sell things really far out of the money. What I'm trying to do is maximize my chance of winning. I don't know the exact delta on this. Certain brokers like Webull or TD Ameritrade will actually give you the actual delta or the actual implied volatility, or the actual delta would show you the percent chance to win. But I can tell from the low amount of money that I'm getting for this trade that my chance of winning was pretty good. And so if it finishes below $125 by March 25th, I get to collect the premium, which is $36, and keep my shares because I currently own the shares. So now you have to own the shares to sell covered calls. You also have to have a margin account to do any sort of options trading. If you get a level 3 options account, you don't have to own the shares to sell covered calls against the underlying equity, because there is the underlying equity you don't own, someone else owns it. AMD right now is trading at $113.46. And so what I'm saying is that if by the 25th of March, if it doesn't go above 125 and it's currently sitting at $113, let's say it goes to 124, I get to keep my shares and they're $36. Same with Lowe's. Let's work on Lowe's here for a second. Let's just see if we understand this concept. Lowe's, I sold a covered call on that for $245 strike. Lowe's is currently sitting at about $235.67. And so what that means is that if Lowe's finish below 245, then I will get $42 plus get to keep my shares of Lowe's. If I look at Lowe's, you can see that my cost per share, I bought it on November 19th and I had one share on the 18th, is $249.23. My covered call that I have sold on it is $245. Doesn't make sense, because if that was to go off and I was to lose my shares, I would lose $423. However, if you include my options in this time, meaning that I had been selling covered calls and selling puts on lows, you can see that my cost basis is actually $243.02. So I wouldn't be losing money or $400 on lows. I'd actually be making about $198, and I would get to go ahead and buy lows again at a lower stock price. Because of the selling the calls and selling the puts brings my cost basis down. You don't just have to buy shares at a lower price to bring your cost basis down. You can simply use options to do that. The same can be said for any of my options that I have open right now, but I'm going to show you one that looks like it's particularly troubling, but I'm going to show you why it's not a problem and why it's something that I would never buy my way out of. At least that's my view. That's my way of looking at it in this current market environment. Maybe you do something differently, but I'm going to do what I'm going to do. So Microsoft, I sold a covered call with a strike of 41 and Toll Brothers 39 and Revolve 39. And Nvidia here is the one I'm going to talk about. Nvidia, when I sold it, I got a strike price. I got a premium of $107, which at the time sounded great. The stock was $217. It looked like easy money. Why would someone give me $107 for Nvidia when it was currently trading at $217? It had a strike price of $257 that expired in like 10 days. Why would someone give me this money? Well, certainly I'm losing, they're winning, because right now Nvidia is sitting at $264. It's currently sitting now at $700 above the price where I sold it for. It's gone up $50. $50 a share since I sold that covered call. Why is that? Well, Nvidia's got this event coming up next week. It's called the GTC. The GTC is it's its flagship technical conference. It's going to be hosted next Monday to Thursday, and Jensen Huang himself is going to come out and talk, and he's the CEO of Nvidia. He's going to come out and talk about all the things that Nvidia has going on. I think we know what Nvidia has going on. You know, they've got all of the ARM, the Grace chip. They've got the autonomous driving. They've got all of the AI stuff. They got all the metaverse stuff. I think we know what's going on there with them, unless they come out and announce some gigantic stock buyback, which they won't, because they're using that money for other things. But unless they come out and announce some gigantic stock buyback or something like crazy, this stock will probably be a sell the news stock next week. So although it's up at 264 right now, I expect it's going to go down next week. It might not, but I think that it will. So that all brings me back to this right here. So I have Nvidia that I think I have Nvidia that I have at that on March 25th, so next Friday, it's got to finish below 257.50, or I'm going to lose the shares at $257.50 a piece, and I get to keep $107. Alternatively, I could buy my way out of this contract for $1,218 and keep these shares, and I don't care about if that's going to happen or not. This is the sort of thing you do on the way up. So let's say it was like $245. I think, well, is this the sort of thing I have to roll right now? So let's go ahead and talk about rolling a stock. So when you're rolling a stock, you're saying, remember, we get money for time, we get money for volatility. So if we're looking at Nvidia, I have to see how far out in time I have to roll this to get my money back. So let's say I have to send it out to June 6th, 17th. And I'm gonna sell a covered call again, sell to open, and I want this price to be, say, $290. They'll give me $1,500 for this, so I get most of that back if I roll it out in time, 3 months, and up in price $30. I get most of that back, but I'm not going to do that. And the reason why is because I think that Nvidia is going to be a sell the news sort of thing. They just reported earnings just a couple months ago, or maybe a month ago, and showed that they just had the quarter of a lifetime. The stock ran up to 265, and as soon as they reported the quarter of a lifetime, the stock went straight down like $40 or something like that. And I think that's going to be the case here. This stock is being pumped because we're going into a conference, and my feeling is as soon as the conference happens, sell the news. It's going to go back down to like from 264 down to like 230 or 235. But let's say it doesn't. Let's say that it keeps going up. Let's say, or it stays the same or whatever. Well, now I'm still at this point selling Nvidia at $257.50 when I only bought it at $217. So I'm still making $4,000, and I'm getting my price back. So I'm going to let this go, and then I'll buy it back when it goes back down to 220. Why do I think it'll go down to 220? Well, the reason why I think it'll go down to 220 is because Nvidia is one of those stocks right now wouldn't be like a stock that's in a recessionary environment that would be highly favorable. And the reason why is because it's a growth stock. It currently trades at a 68 price to earnings ratio. The forward PE they believe here is 47, meaning that next year at this time they believe it will be 47. I think it's going to be considerably lower. That's my opinion. This is theirs. But in any case, this is a very expensive stock. So I believe that once the news comes out, they're going to sell it. This thing's coming back, and this option price is going to go from $1,200.18 that they're just going to end up paying me $107. I'm keeping my shares, and this thing will end up at like $245. So that's what I'm going to be doing with Nvidia. And of course, like I said in the last video, I'm going to be selling puts on Adobe. I'm going to try and get $100 out of that this coming Tuesday. And so I'm going to play earnings and sell puts on that. And I'm going to continue being a vulture and get my money where I can get it. And that's it for this here video. So hopefully you got some out of that. I know it was technical. I know there was a lot of stuff there. I know it was very bird's eye view. I know it was high level. But please, if you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, I'll let you know what I'm doing from week to week, and we'll see you next time. Have a good day. Bye.